Now that we've created our Wave account, there's a few things we need to do before we begin entering any transactions or importing any transactions, and that is dealing with our chart of accounts. So you can get to your chart of accounts in Wave either by clicking on the button here for Customize Accounts or by going up under Accounting and then Chart of Accounts. Now across the top here, you'll see the different types of accounts that you can create inside of your chart of accounts. One section is going to be your assets. Another section is going to be your liabilities and credit cards. You'll have income accounts, expense accounts, and equity accounts. Now you'll notice here that assets is underlined and it says two here. That means that there's already two accounts, standard accounts, that Wave has set up inside of the system once you've gone ahead and created your account. The first one is cash on hand, which is a cash and bank account, and the other one is an accounts receivable account. The Going through the first section here, the cash and bank accounts, for every bank account that you have, whether it's a checking account or a savings account, you want to create a new account for each one of those. If you end up having a company investment account, go ahead and create a new account for that as well. This helps out a lot at the end of the month when you're trying to reconcile, because you'll be able to reconcile each of your accounts. If you use a third-party processor who handles your credit card transactions, enter that account up under money in transit. The reason we do this is because they are actually holding funds for us which haven't been deposited into our bank account. So we need to reflect those on our financial statements. So we have to make sure that we include those, in our accounting software. So if you have something like Stripe, PayPal, something like that, go ahead and create a new account, for each different company that you actually have accounts for up under money in transit. If you were running a pretty straightforward business, as far as inventory, you could possibly get away with just having one main inventory account. If you wanted to have greater detail, you could assign separate categories up under the inventory account to give you greater detail. So, for example, with our fictional gaming related retail business, we're actually going to create three separate inventory accounts. One's going to be for console, one's going to be for accessories, and then another one's going to be for software. Property, plant, and equipment would be for your fixed assets. So if your company owned vehicles, if it owned machinery, office equipment, you can go ahead and, depending upon the size of your business and how much detail you wanted, you could possibly get away with just lumping everything up under one category. If you wanted a greater detail, you could have one fixed asset account for your vehicle, one fixed asset account for your office equipment, and so on and so forth. Depreciation and amortization are actually expense accounts, but because they offset fixed assets, that's why they're actually listed up under here for asset accounts. Now, depreciation is the amount of wear and tear that's used on equipment over time. So you're actually recording that up under your depreciation. Now, these are for physical assets. If you own something like copyrights or trademarks or patents, you can go ahead and create separate accounts for those as well. But over time, they're actually amortized as opposed to depreciated. Vendor prepayments and vendor credits, those are also going to be considered assets because these are things that you have prepaid to your vendors and the service actually hasn't been rendered yet. Then you have other short-term assets and other long-term assets. Other short-term assets would be any asset that you have that will actually be consumed or used within a 12-month period. Then you have other long-term assets, which are assets that you'll be holding for longer than 12 months. Now we're going to create a couple of bank accounts. So we're going to click on Add a New Account. It's going to be a cash and bank account. And the bank that this fictional business is using is called Prime Bank. Now they set up two different accounts. One is going to be for all of their operations. And we're going to click on Add a New Account, and we're going to add a separate bank account It's still with the same bank, but they want to have all of their payroll expenses coming out of a different bank account. One save. Okay, so now we've got our bank account set up. Now we will add our Stripe account. Going to be a money in transit account. We will name that Stripe. Save. Accounts receivable is already in there, so we don't need to do anything with that. Next, we're going to add some inventory accounts. Now, as I had mentioned before, if you have a very small business, a simple business, maybe you can go ahead and get away with only having just one main inventory account. But for a fictional business, we are going to create 3 separate accounts. Now, these are just categories. You don't want to create a new inventory account for each different item that you have, but we're going to do it just for the different categories. So, as I mentioned before, this business has consoles that they sell, accessories, and games. So, those are the 3 accounts that we're going to create here. For your individual products, you're going to use a different section where you're actually going to put in your products that you offer or your services, and they'll be listed in a separate section. But as I said, for the inventory part here, we're just going to add 3 different accounts, one for console, accessories, and games. The first account is going to be consoles. Click on save. I'm going to create a new account for accessories. Save. And then our final inventory account that we're going to create is for games. To account for our depreciation, we're going to create a new depreciation account. And since they only have just one equipment fixed asset account, we're just going to create an accumulated depreciation account for the equipment. Every time that we have any kind of depreciation expense, it's actually going to drop down into our accumulated depreciation to offset the value that's in the equipment fixed asset account. Under vendor prepayments, we added a prepaid insurance account and a prepaid rent account. The reason we put these up under prepays or because with insurance and rent, sometimes you may pay for an entire year all at once. Now the thing is even though you've paid for the entire year, you don't want to record that as an expense in this, during 1 month's period. So you're actually going to be drawing that down over the period of a year. So for your prepaid insurance, if you pay it in advance, that amount would go into your prepaid insurance, and each month you would record an insurance expense for 1/12 of that amount. And each month you would go ahead and draw down your prepaid insurance account. Now, the money that's left in there is considered an asset. So that's why we go ahead and put that up under vendor prepayments. Same thing with your rent. If you pay your rent a year in advance, then the whole amount would initially go up under your prepaid rent, and each month you would record a rent expense for 1/12 of that amount, and then you would just draw it down over the period of a year. So at the end of the year, these 2 accounts should end up being 0 until you start the next period and make your next payment for the year. Then we have also included a security deposit up under other short-term asset. Now, if you were renting your space, for your business, and you're only planning on being there for a year time, then I would create a security deposit account up under your other short-term asset, because within a year you're going to be getting that back. Now, if you're planning on staying at your location for more than a year, I would create your security deposit up under another long-term asset. Now we're going to add some liability accounts to our chart of accounts. So we will click on liabilities and credit cards. So for each credit card account that you have, you would want to create a new account for. That way it makes it much easier at the end of the month or when you get your statement in order to reconcile. It makes it a lot easier. So we're going to click on add new account, and our business has a PNC Visa credit card. Created that. Then if you have any loans or lines of credit, you would want to go ahead and create a new account for each of those as well. That way, so when you get your statement, they're easier to reconcile. Expected payments to vendors would be your accounts payable. So they already, Wave already has a standard account listed in here. Sales tax, you would want to create a account here for each of the different taxing authorities that you have to pay money out to. That way, so you can reconcile whether you're paying federal taxes, sales taxes. Go ahead and keep those separate. Payroll liabilities was an account that they already had created in here when we set up our account. So payroll liabilities would be basically as a holding account to record and reflect the expenses that you have for payroll that you have not yet paid out. So this would be something like when you are reaching the end of the month, and say, for example, you pay your employees every 2 weeks, and the last time you paid them was on the 25th of the month. You still have a few days worth of liabilities that you haven't paid out yet, but they still need to be reflected on your books. So you could go ahead and put that accrued amount into your payroll liabilities account. That way, so at the end of the month, even though you haven't paid that money out, you know it's still going to be paid out in the next month, but you've actually accrued those 5 days worth of payroll liabilities, for that particular month. So they would go up under payroll liabilities. And then when the checks actually get paid out, then the money would be reduced out of your payroll liabilities and paid out, in the following month. If you have any money that's due to you or other business owners, you could go ahead and create an account here. Customer prepayments and customer credits. If a customer pays you money in advance and you're going to perform a service or sell a product to them later on, until you actually do that, that money that the customer has paid you is really a liability, because if you don't perform that service or sell them that product, then that money has to get repaid. So until you actually have earned that revenue, whether it's providing a service or selling a product, that money needs to be considered a liability. So it's going to go up under your liability accounts for customer prepayments and customer credits. If you have any other short-term liabilities, you would click on those. So we're going to go and add, we already have a wages pay or payroll liability, so that would be the same thing as a wages payable. We are going to add a payroll tax liability account. So let's see, due for payroll. We will go ahead and click on and add it here, due for payroll. So now payroll tax is what your business has to pay out to the different taxing authorities. So we're going to click on save here. For our income accounts, you'll see that Wave has already automatically generated a product sales income account and a sales income account. They're basically the same thing. So the thing is you don't want to end up having a lot of accounts in your chart of accounts that are similar. So you can, if your business was simple and you didn't really have much in the way of different types of sales, you could go ahead and get away with just having one account. Now, in this particular case, since you have two of them that are similar, I would either rename them to different accounts, or you can just inactivate or archive one of them. That way, so it makes your books a lot more clean if you have things compact. So now, in this case, for our business, we want to classify our income, break it down to give us a little bit more detail. So we're going to go ahead and rename these two accounts here. So the first one, we are going to do console sales. And this is for the sales for strictly for consoles. Then we're going to rename this one to be specifically accessory sales. And then we're going to create a new account, and that's going to be our game sales. And then coming down here, we're going to have a discount account. Now, the reason it's up under income is because it's actually going to be offsetting income. So whatever amounts that you apply to your discount account, it's actually going to be like a negative number. So it's going, whatever you have for your income, it's going to minus off the amount that you have up under discount. So we're going to create a discount account, save. And even though you go ahead and offer discounts, or you may be offering discounts, you also want to have a refunds account as well, because that's also going to offset your income. So it just gives you greater detail if you have these split out, as opposed to just having a discount and refunds single account. So now you can find out how much money you're offering in discounts and how much money you've refunded. Other income would be something that's not a typical sale for you, or a typical type of income that you get. So that could end up being something like interest income. So we're going to add an interest income for money that we make from the bank on our deposits. And then you have uncategorized income. Now, this is just a standard account. So this would end up coming up if you have bank feeds where you've connected your bank account to Wave. So when things get imported into Wave, if there's no rules being set up or anything previously, and Wave doesn't automatically know which account these expenses are supposed or income is supposed to go to, it'll just drop into a uncategorized income account, and then you would just have to go through each of those transactions and give them apply them to a particular account. Gain on foreign exchange. If you're not dealing with multiple currencies, then you wouldn't even have to worry about this account. Now we're going to work on our expense accounts. So you can see here that Wave automatically generates a handful of these accounts here. So just go ahead and look through the chart of accounts up under your expenses and see if there's anything in there that you need specific to your business. If you have accounts that are in here that you doubt that you're going to use, you can make them inactive. That way so they won't appear on your reports. For example, we've got one for advertising and promotion. In your business, maybe you would like to keep your advertising expenses separate from your marketing expenses, so you can actually split those accounts out, and we will go ahead and do that in a few seconds. So we are going to split out our advertising and promotion account. So we're going to click on edit, and then we're just going to modify this and take out the and promotion. Then we're going to create our marketing and promotion account. So remember, that was an operating expense. So we'll scroll down here, click on operating expense, and we will add one for marketing and promotion. And we're also going to add, see down here we have an insurance account for vehicles, but we also have a business policy as well. So you want to create another account specifically for that. Operating expense, and this will be insurance, and we'll just call this business. We've already created our marketing and promotion expense account, and then we're just going to create a general office expense account. And that'll basically be like a catch-all for just like general office expenses. We will create our cost of goods sold account. And down below, there's already a merchant processing expense account for processing our credit card transactions. And they already have a number of payroll expense accounts that they've created. And uncategorized expense would also be when you're doing your bank feeds. They're coming through. Wave doesn't really know which account they should be allocated to, so they'll just drop it into an uncategorized expense. But you want to make sure that you don't have any uncategorized expenses or uncategorized income. You want to make sure that they actually get allocated to a proper account. So when you're reconciling all your accounts, each month, make sure that you don't have anything left over in uncategorized expense or uncategorized income. And the final section we have is on equity. Now here we've got a business owner contribution and drawing account. So in this particular case, it's best to set it up so that you have one for each of the different owners of the business. That way, so it's a way of keeping track of their individual contribution of assets into the business and their individual withdrawal of assets out of the business. And then the final account here is retained earnings, which is the profit that's drops down each year to show how much value the net worth of the business after all of the expenses and liabilities have been taken care of. So we're just going to create 2 accounts here for the different owners. This one here we're just going to modify, and the one owner is Derek. And we'll add another account for the other business owner, and her name is Samantha. And that finishes setting up our chart of accounts.